Well, welcome to another episode of Finance Uncut, where we talk everything finance and economics with an Austrian flavour. On today's episode, we're going to have a look at the Fed, deficits, inflation, and the US dollar, and what to expect with the outlook of the economy. So with that, let's get to it. Well, coming in from Barron's, we've got this article, Rising Deficits, Inflation and US Dollar, a risk to come, BlackRock Sphinx says. So rising deficits, inflation and the supremacy of the US dollar are concerns for the coming years, Larry Fink, CEO of BlackRock, said at the Morningstar Investment Conference on Thursday. In the short term, I believe we'll have to have rising deficits, Fink said. In the long run, I'm worried. One particular concern is Japan and China, two nations that are aging very rapidly, and that in the next 10 to 15 years could transfer from saving to spending nations. In those cases, what will be the role for the dollar? The US could grow its way out of its deficits and other problems, which would make the dollar and US investments a favored currency. But if it doesn't, in the next 10 to 15 years, it could be a problem, he said. Fink said that, as the Federal Reserve said this week, that it would be more tolerant of inflation. The biggest risk out of the next 3 years is inflation, but not yet. We see more deflationary pressures. This week, the Federal Reserve said it would keep interest rates pinned to the floor, with no rate increases envisaged all the way through to 2023. While it continues to purchase $120 billion of Treasury and agency mortgage-backed securities each month. And that's a real problem, isn't it? That the Federal Reserve is going to keep its interest rates pinned to the floor. Some say that they will be forced into going negative. But that just takes all those savers out and puts them into financial assets to get a return. So it creates more risk. It creates bubbles. I believe we're seeing a bubble at the moment, especially in the NASDAQ, but right across financial assets. And that's simply because people can't get any return on their savings. 20 years ago, if you had just under $900,000, you could generate about $50,000 in interest a year. Now, to get $50,000 in interest, you need something like just under 900,000. I think 9 million, about 8.3 million to the numbers that I recall. And so people can't get a return, so they're forced into risky financial assets, and that creates bubbles, because we know at the moment that the market is not reflecting the real economy. It is a liquidity-driven market, but it's going to create a lot of risk to the downside, as far as I'm concerned. With the Fed is risking letting the inflationary genie out of the bottle, and when they do, it's going to be very hard to put back in. And even the deflation folk out there, even they say that they believe deflation's coming first, and then some type of stagflation. Some say hyperinflation, but mostly that stagflation position after a period of deflation. But what I also wanted to show was this interview by Mohamed El-Erian talking about Jay Powell's meeting he had this week. So let's have a look at this.
Are markets suggesting to you that there's more people willing to step in and buy the dips than the opposite?
So the last 24 hours have been fascinating for me, because you've seen a massive tug of war, and it's all happening in the liquidity sphere. It's not happening in the fundamental sphere, it's happening in the liquidity sphere. And I think what happened basically is the Fed first surprised on the positive side, then some misstatements at the press conference shook a little bit the impact of the Fed. And now we're seeing this tug of war going on between people more willing to question this market, to test the valuations because we have no Fed meeting for almost 2 months, versus the buy on dip mentality. And that tug of war, we got to look very carefully, because if we lose the liquidity support, the fundamental support is way below where valuations are right now.
What was the Fed misstep, though, Mohamed? I mean, the liquidity support's very much there, right?
So there's no doubt that in terms of what they had in the statement, it was much more dovish, with the interest rate pushed all the way back to 2023. And the markets went up. When we got to the press conference, the tone of Chair Powell, the way he dealt with fiscal issues, and then as Steve said yesterday on your show, he stumbled. He stumbled when it came to answering the question about financial stability. He stumbled when he came to answer the question between the difference between guidance on the interest rate and guidance on the QE, one very specific, the other one very general. He stumbled when asked, well, how can you get to the inflation rate if you yourself don't believe you're going to get there? And he stumbled on the Main Street lending program. And I think it's those stumbles is what impacted markets the most.
Really? I mean, I don't know. I think, Mohamed, those are all really hard questions to answer right now. And you know those forecasts going out several years to predict an inflation number for those forecasts is pretty much impossible, and they're constantly revising it. I think the message was pretty clear, and that is we've got a new framework and we're going to be on hold for a very long time, and a little bit higher prints on inflation aren't going to scare us. I'm not sure that there was any actual missteps or messages that didn't get heard.
So you and I think that way, but step back a little bit on that. People say, well, wait a minute, if he's willing to be specific on interest rate, why is he not willing to be too specific on QE? Because QE is really important when rates are zero for a long time. It is QE that's going to move the market. Issue number one. Issue number two, when asked about what about financial stability, the answer was very backward looking. So that raises concern, will financial stability be a problem to this policy paradigm? And finally, there's the question of how long can you disconnect the financial system from the real economy? If you're not that confident about the real economy, can you really continue pushing asset prices higher? So I think it is a really complex time. The answer to all this is it's not about the Fed. It's about lawmakers in Washington. It's about fiscal policy, and it's about structural reforms.
Yeah, there we go. I agree with Mohamed on this point, and people are starting to lose confidence in central banks, that we've got this big problem and that central banks won't be able to save us. Look, people I follow like Jeff Snyder and even former Fed insider Danielle DiMartino Booth basically just talk about this Fed put being a myth, and that the Fed cannot save us, but they want us to think that they can save us, so that we'll go out and think that it's all okay, and we'll go spend money and we'll do all these things. It is a liquidity driven market, as we say, but how does the markets and the real economy, it's disconnected. So how does it reconnect? Either markets have to fall or the economy has to boom. And with across the West, with aging populations and record high debt levels, both from a household point of view, corporate point of view, and now government point of view, I don't see where we're going to get a massive booming economy like we had from the 80s onwards. So I see a lot more risk on the downside to this, so be very careful. And this is why, a lot of people like myself have, over the last probably 12 to 18 months, been getting into gold and silver. Not so much that we think there's going to be super hyperinflation, although longer term, yes, I do think there's going to be significant levels of inflation, as in the consequences of inflation. But also, I actually don't believe the CPI numbers that are reported. I've just looked personally at my own living costs, and they are certainly going up a lot more than the reported CPI numbers. You could look at shadow stats and look at how inflation was reported in the 70s, 80s and 90s, and it was different to how it's reported today. So you're not measuring apples with apples when you're comparing today's inflation or CPI data compared to CPI data in the previous decades. But it's those that are losing faith in central banks being able to maintain the system. And the dollar, the US dollar, being the reserve currency, is a threat. When does it end? I don't know. But I do know that it's in the last that last period of it being the reserve currency. And so for me, I don't want to play in the Nasdaq. I don't want to buy things that are 30 to 100 times earnings, or buy things that don't even have earnings. So the only thing that's real that doesn't have counterparty risk is gold and silver. And so, a lot of my portfolio, or the largest portion of my portfolio I've ever held in gold and silver is now, and I've been doing that for some time. But anyway, it's a wait and see. It's really, a day by day, week by week, month by month, and year by year. I still don't think that we've really hit the real tough times yet, until all the mortgage moratoriums and the rent moratoriums and the wage subsidies and the insolvency moratoriums, and we really see what the state of the economy is like. We'll find out next year, I believe. And all I can say is just get prepared, be ready, get your financial house in order. It's never too late. But until then, I'll see you next time on another episode of Finance Uncut. See you then.